for do-it-yourself investors. First of all, I want to congratulate you. I think it's a good thing for more people to start participating in the stock market and getting involved in an industry that used to be very exclusive and very hard for the average person to really break into or make any progress with. So good for you for getting involved, but I do want to mention 3 tips that I have for people to watch out for if you are a do-it-yourself investor. My name's Misty Lynch. I'm a certified financial planner and a certified life coach. So these are going to focus on some of the thoughts that are going to come into your head if you are a do-it-yourself investor, and I want you to catch yourself if you find yourself falling into these traps. The first thing is fear. Fear is a big motivator, and when somebody is investing on their own, they might fall victim to fear in a few times. Specifically, if they're trying to time the market and they're trying to decide whether they should jump in or stay on the sidelines. Fear is often going to keep you from investing your money because our loss aversion is much stronger than our desire to make more. So you might see yourself waiting and waiting and waiting and missing those opportunities to invest, where you might have just been better off to have a strategy where you systematically start investing and stick with it. Also, fear will drive people to sell at the lows. So you might see that every year there's going to be market highs and market lows and a lot of different days in between. But there's always going to be somebody who sells on the worst day of the market every single year because they got afraid that their money was just going to keep going and they couldn't handle it. And those people often don't know when to get back in the market. So there might be a lot of investors who maybe in 2008 decided to get out of the stock market, and then they stayed out for good and they've missed out on the bull market that we've had and the record highs. Another thing I want investors to think about is greed. Now, usually there's a big swing between fear and greed. You can even see it if you look on some websites. You can see that there's a fear and greed index when it comes to investing. So it's very common to see things going up and up and up and up and wanting to get in on the action. I think we've seen that a lot recently, and it's really hard for people to feel like everybody else is winning and I'm not. So you might want to get involved when the market is actually at an all-time high. So you might be buying an investment when it's at its peak. And then that might cost you money if you didn't really have a strategy for when to get into it, and you might hold on to it for a while because you want to see those returns that may not be there. This is also a time when people might sacrifice some of their other financial goals. Maybe they take money out of different accounts that were earmarked for college funds, retirement savings, emergency funds, and use those money to invest in a way that's a little bit more aggressive than they initially planned to use that money. So this can cause some problems. So it's really important for people who are feeling that desire to invest right now, they don't want to miss out, to really have some time to think about what they're doing before they jump in. The final thing I want to talk about is overconfidence. So this can impact people who have maybe made a great investment. And I believe it's a little bit easier to buy a great stock than it is to know when to sell it or know what to do with that money when you sell. So you might get a great tip, but you might have no clue how long you're going to hold that position for or what's going to make you decide to sell it. So if you don't have a strategy and you're overconfident, you might be invested in a position and really have no idea what you're going to do with it. So I think it's really important that if you get one good result, you don't then just decide that you are a good investor. I think it's still going to be important to have a real defined strategy about when you're going to sell that position and what you're going to do next. At our firm, we have a very strong investment philosophy where we have very strict rules about what we buy, when we're going to sell it, and what we do with the proceeds. Now, we don't fall in love with a particular stock. We don't stay invested in something that does not meet our criteria, and we're very strict about that, which has allowed us to be very successful. So if you are a do-it-yourself investor, I think it's really important to think about how you're going to get out, not just how you're going to get in. If you'd like to invest in an active portfolio or talk to a financial planner about your do-it-yourself plans, I would love to speak with you. I think it's really exciting and it can be very fun to learn about the market. Please feel free to reach out to me at mistylynch.com and we can set up some time to talk. Thank you.